So I want to welcome everybody to Understanding Financial Ratios. We had Ramesh Advani. He's going to from SCORE Boston chapter. Will be giving this presentation, and this is a presentation that does have a good amount of information. We will make sure that you get that recording link, and then any other materials that are important to help you move forward with the information you learned today. So as we get started, if you are not familiar, we'd like to introduce you to SCORE. SCORE is about sharing information to the small business community, and we do that in a couple different ways. One is through the information on our website, score.org. You can find templates to download, templates for business planning, marketing planning, budgeting, cash flow, all kinds of different templates. There's information in form of articles, blogs, and recorded webinars, and of course the live webinars coming up. So lots of great information to look for, which brings me to the next way we provide information, which is through our workshops and webinars. Most are online to maximize the number of people we reach, but we do have a few in person. So if you want to watch for the newsletter, you can also find them listed on the website. And we do share a few on social media as well. The most important way that SCORE shares information is through mentoring. And our mentors are volunteers. They come to us with a wide range of experience and knowledge. They've learned from both their successes and their failures, and they want to share that information with you. We work with those that are trying to decide if small business is right for them. We're working with those in the planning phase, and we're working with those that are already in business. They want, on that first session, they want to learn about you. They want to learn about your goals and your challenges, and they're going to work with you to put together a plan to meet and overcome. And the other part of the wonderful thing about SCORE is that they work as a team. So even though you've met with one person, they are reaching back to the other mentors in the group to make sure that they're providing you with the best information possible. So it's a wonderful experience. I strongly encourage it. If you haven't tried one of the meeting with a mentor, I strongly encourage you to give that a go. Now, how do you get one? Super easy. Score.org website. There's a blue box. You can type in your zip code, and that'll match you to the chapter that's nearest you. And we'll ask you a couple questions and use that information to connect you with the mentor that can best assist you. We are going to use the Q&A button on the Zoom bar. It just helps me keep track of questions. That is for questions to the presenter. So if you have a question for the presenter along the way, please put it in the Q&A on the Q&A button. Everything else can go into chat, no problem. I do monitor both, but I can't guarantee I won't lose track of a question if it gets put into chat. So the other important information, like I said, is the recording. And we will try and get that recording posted by tomorrow at score.org/Boston. And you can see from the graphic, it's under the local workshops on the blue bar. Previously recorded webinar is where they're all listed. So I'm going to pull this down, and I'm going to turn it over to Ramesh. It's all yours.
Thank you. Thanks, Teresa. Hello, everybody. I'm going to share my screen if you just give me a second. Hi, I hope everybody can see my screen now. So welcome. I am not going to make any presumptions about your understanding of numbers, but I do hope everyone on this webinar is a business owner or plays a pretty significant role in running the business. So this is a very useful set of information that you should be thinking of, even though you're not a finance person. These are the financial bits of information for your business that you really need to make sure you understand inside out to stay on top of things. So I don't have complicated slides. I'm going to go fairly slowly with um, with the slides. I'm going to start off by telling you what are ratios. And after the introduction, I'm going to go through four kinds of ratios. Now, in the financial world, um, there are all kinds of metrics and measures that you can have. And in the area of financial ratios, these four areas that I'm going to talk about are the ones that are the most useful, and they're straightforward, and they are the kinds of things that you should be able to calculate or look up yourself for your business. So let me start about uh, overall on ratios. So ratios, financial ratios are simply indicators. They don't tell you exactly where your business has a problem or where your business needs to make some changes or what's going on very well. However, those are early indicators and tell you how things are going. So it's important to think about them as not the final solution to the problem or issue you might have, or not just a pat on the back just because the financial ratio is the way it is. Now, why should you look at ratios? Because you want to take action and you want to stay on top of it and make sure your business stays profitable. And it's pretty straightforward business reasons to look at it. And also, if there are specific areas of the business, when we look at some of the ratios, I'll tell you, okay, if this ratio looks like this, then maybe you should talk to XYZ in your business, or talk to, say, your accountant or whatever. So those are the things that you should look at. And what are the documents that you need to calculate ratios? And there are only two documents that you use to calculate ratios. One of them is your profit and loss statement, your P&L. And the second is your balance sheet. So all you do is put your balance sheet and your P&L in front of you, and the ratios I'm going to talk about will take numbers from those documents. And you can calculate your ratios. Now, these documents are available to you probably online from your financial system, or your accountant should be able to produce them. You know, you can produce a profit and loss statement for the month, for the quarter, for the year, and the balance sheet is a point in time look at the information, so you can produce a balance sheet at any time. And when you're doing these ratio calculations, what is the time frame you should look at on the document? So our recommendation is everything is a function of how you run your business. But generally, you should look at your ratios at least once a year, if not every quarter, just to see how your business is faring, how things are going. So I'll pause here and see if there are any questions that anyone has just overall on financial ratios before we dive into each of the ratio areas.
We don't have any questions yet.
Okay, thank you. So as I said, we are going to look at ratios in four different areas. So please don't get overwhelmed. We'll start off with liquidity ratios. Liquidity ratios are things that tell you how you're doing in terms of your cash. Operating ratios tell you how is your operations running and what are some areas that you may want to look into your operations if the ratios are giving you those indicators. And then the most common ones are the profitability ratios, And I'm sure when we show you the ratios, you will say, oh yeah, I know what, I look at this all the time. And the last one is working capital. So let me start with liquidity ratios. What do liquidity ratios do for you? Liquidity ratios, they help you understand if you can meet your short-term obligations using cash or cash-like assets. What are cash-like assets? If you have any stocks that you own that is owned by the business in the name of the business, that's a cash-like asset. The other one is your accounts receivable. These are cash that you have not yet received because you have sold products on credit. All of those are cash or cash-like assets. By looking at this ratio, you are going to get a heads up to make sure at any point in time you're avoiding default on any loans or credit that you have, and avoid bankruptcy. Bankers and analysts and creditors, when they ask you for your financial statements, they pay a lot of attention to these two ratios. So there are quite a few liquidity ratios, but we're going to talk about the two main ones. One is called the current ratio, and the next one is the quick test ratio, or it's also called colloquially the acid test ratio. So the current ratio, to find out what your current ratio is, if you looked at your balance sheet and you took the current assets on your balance sheet and you divided them by your current liabilities, that number is your current ratio. You should try to monitor this and make sure that it is either greater than 1.5 or 2. If it's less than 1, it means that you're not solvent. You've got current liabilities, and a definition of a current liability is anything that has to be paid within less than 12 months. So obviously, if you should have your current assets to be double that of your current liabilities, or at least 1.5 times your current liabilities. That's the current ratio. Everybody knows what current assets are. The assets that are not long-term assets are called current assets. And on your balance sheet, they would show up as cash, accounts receivable, inventories. The other ratio is the quick test ratio, which is from your current assets, you leave out the inventories because you cannot liquidate your inventories very quickly, or at least not as quickly as cash or receivables. So if you take your current assets total, subtract your inventories from that, and then divide that net by the current liabilities, that's a quick test ratio. You should make sure that your quick test ratio is greater than 1 or 1.5. So, I mean, if your quick test ratio is 1.5 or more and your current ratio is greater than 2, you are pretty solvent. You're running your business in a fairly solvent manner. So those are the two liquidity ratios that you could look at. Again, these are looking at numbers from your balance sheet. Any questions?
No questions.
Okay, great. I'll move on to the next set of ratios, which is the operating ratios. Now, when you look at your operating ratio, what is that telling you? That is telling you, go look into this part of your operations and think about what you could do. So the first operating ratio is the operating profit percentage. What is the percentage of profit you're making based on your operations? And that information, to calculate that, the number, that percentage, that information is on your P&L. on your profit and loss statement. How do you calculate that? You take your profit and you divide that by your sales dollars, or your revenues, however you call them, and calculate that as a percentage. And this is the profit on your profit and loss statement before taxes or any other miscellaneous income. So this is true profit coming from your business. So how can you use that information? You calculate out your operating profit percent for your, say, for your current quarter, and you compare it to what that profit percent was with the previous quarter, or you calculate it on what it is year to date this year versus last year, and you look at that percentage. And if that has dropped, then what you can do is go in and look at, from a marketing standpoint, should you be adopting or changing some of your pricing strategies to make sure that you're making the right kind of profit that you were either making in the past or what you budgeted to make? The other area, of course, is if your profit percentage has dropped, maybe your costs are running too high. And so you should look into areas where you could do some cost reductions. So those are some operational areas that you can look into by looking at your operating profit percent. The second operating ratio worth looking at is what is called the inventory turnover ratio. Now, this is a relevant ratio if you are either manufacturing a product and then you're building inventory and then selling it, or it could be if you're in the merchandising business and you are buying product and selling it. So even though you're not making it, you still may have inventory stock that you have to keep. So the inventory turns ratio, you have to take two numbers. The first number is your inventory dollar value, which comes from your balance sheet, and the cost of goods sold, which comes from your profit and loss statement. So if you take your average inventory dollars from your balance sheet, now how do you get the average inventory dollars? Again, these are indicators, so you don't have to get very complicated. Take a balance sheet for the time frame that you're looking at. So for example, let's say you take a balance sheet at the end of year one, and then you look at the balance sheet at the end of year two, and look at the inventory numbers on those two balance sheets and do an average of those two numbers. That'll give you the average inventory dollars. And then you divide that by the cost of goods sold in that year. So like, let's say if I was going to do my inventory turns ratio for the year, fiscal year 2023 that just ended, I will look at my balance sheet at the end of 2022. Then I'd look at the balance sheet at the end of 2023, and I look at the inventory numbers, do an average, and I'll divide it by the cost of goods sold on the profit and loss statement for 2023. So what does the inventory turns ratio tell you? It tells you how often is your inventory getting depleted or needs replenishment. So for example, if your inventory turns ratio was 12, it means every month your inventory is turning over. If your inventory turns was 4, then it means every 3 months your inventory needs replenishment. Now, you can't just look at the actual number to reach a conclusion. You should compare to your competition what is their inventory turns ratio? Or if there is if you have industry standards, all industries have standards for all these ratios. You find out what your inventory turnover is compared to your industry. And if you have too high a turnover, it means you might be, you're spending so much energy trying to replenish your inventory, you might be missing sales opportunities. So this is another operating area telling you where you need to go and take action and look further. So are there any questions on
Yeah.
operating ratios?
Yeah, can you clarify on the operating profit ratio? Is that gross profit or net profit? Can you clarify that?
Sure. That's a very good question. It can be either or both, depending on your business and where most of your costs are and where does your profit come from. So, for example, you could do a gross profit percent ratio and monitor it, and you might have very few costs that go beyond the cost of the goods and are in what are called selling and general administrative expenses. So but if you do have a lot of selling SG&A expenses, then the profit that is on your P&L after accounting for that is called the not the gross margin, but it's called the operating margin. So you could look at your operating profit percentage even at that level. So it all depends. There's no one set answer for this. It depends on how you manage your business and which costs you want to look at.
Are there any average operating ratios by type of business, and where would you find them so that you can compare your numbers?
That's very good. You could look at it's actually these days there's so much information available, and for your industry, if you're a small privately held business, obviously you can't get the profit percentage ratio of other privately held businesses. But in every industry, there are publicly held businesses whose data is very easily available on general public websites like Yahoo Finance, or you can go in and look up that company's ratios right on the web, and or you can just even do a Google search of industry ratios and bring it up. Now, a word of caution: you shouldn't look at ratios that are too far back in history. You should be looking at things at least over the last 1 to 3 years. The other thing is you should also look at how your own ratio is doing compared to your own performance over time. Many times, some ratios go south when the economy is down or your sales are not growing. So, yeah, you can get public information very easily.
On the operating ratio, what is the sales quantity to factor? Is it per item / sale per month?
No, for the operating profit percentage, you just use dollars. Don't go into quantities. So you just look at the dollar number on your profit and loss statement.
That's all we have for now.
Okay. All right. So we've gone over the liquidity and operating ratios. So let me go to the next one, and that's the profitability ratio. Now, some of this may sound the same as some of the profitability, the operating profit percent ratios, and it kind of actually addresses the question that someone asked. So here there are three profitability ratios you should look at. One is the gross profit margin. These are now dollars, not percentages, but dollars we're talking about, but the same numbers. The gross profit margin is you take your net sales and subtract the cost of goods sold, and you divide it by your total revenue. Your gross profit margin should be stable or increasing over time, not declining. And if you do, and I hope and assume you all do budgets, it should also be equal to or better than the gross profit margin you have budgeted for that period of time. These numbers for the gross profit margin also come from your profit and loss statement. The next one, which is called the net profit margin, Net profit margin is looking at your earnings on your P&L after taxes, which is divided by the total revenue. So again, you should make sure that your net profit margin is staying stable or increasing. If it declines year over year, or if the net profit margin in your industry is higher than what yours is, you should be looking at what's going on specifically with your costs or with your own management effectiveness of your business. So those are two profit margin profitability ratios that are based on information from your profit and loss statement. The third one is the return on assets, or the ROA. The ROA is a measure on how much profit is generated from each asset dollar that is invested in the business. To calculate this, you would take the numbers from your profit and loss statement and your balance sheet. And how do you calculate it? The return on assets is your net income, which is from your profit and loss statement. And net income is this net income after taxes, etc., which is divided by the average assets for the period. How do you calculate average assets? This is again taking a balance sheet at the start of a time frame and a balance sheet at the end of the time frame, and looking at what your average assets are by taking those two asset numbers and averaging it out, dividing by 2. Where do ROA numbers matter? ROA numbers matter when you're looking for people to invest in your business. What is the return that they would get? And they would look at what your return is on your assets. Generally, service businesses have ROAs which are higher than manufacturing businesses in terms of what they look like. So those are the 3 profitability ratios that you should think about in addition to the ones that we just talked about. Any?
Yeah, what do you include in the COGS?
And the cost of goods sold?
Mm-hmm.
All of the, it should be on your P&L. Can somebody be a little bit more specific? It should just say it's the cost of goods. It'll be exactly what it says. All your costs. It's not your selling expenses or your administrative expenses, etc., or your any of that. That's not included in that. It's specifically the costs of all the items that you hold in inventory and that you then turn around and sell.
What items do you include in the assets for manufacturing business, for instance?
What are the assets? Well, the assets, whether it's a manufacturing business or a service business, when you look at your balance sheet, on the left-hand side, you see the total of all assets is all assets. And if you look at the right-hand side, the liabilities and equity will be equal to the assets. So it's all assets.
Thank you.
Okay. So I'll go to the last one, which is working capital ratios. And in the working capital ratios, when you calculate those, there are 2 that are very important that you should think about. One is your gross working capital, which is a very simple subtracting your current liabilities from your current assets. That's your gross working capital. Why is that important? Because it's pretty self-evident. The more gross working capital you have, the less you'll have to borrow when you need cash to manage your business. And yes, cash flow always goes up and down during the operation cycle in a given year, but the higher the absolute amount of gross working capital that you have is going to be very useful, because your cash flow is dependent on how quickly your customers pay you and how soon you have to pay your obligations from your accounts payable and also your payroll that you have to commit to paying. So the gross working capital is very simple, very straightforward, and that information comes from your balance sheet. The second working capital ratio that you should look at is your debt to net worth. So if you took your total liabilities on your balance sheet and divided by your shareholders' equity, that number is your debt to net worth ratio. If your debt to ratio is lower than 1 or 1.5, that's pretty good. The higher the ratio, it means you're relying a lot on borrowing as opposed to having your own retained earnings, your own business capital to fund the long-term operation of your business. So those are the two. So as you can see, there are lots and lots of ratios, but pretty much in each category, I've talked about two different ratios. Other than the operating ratios, there were three that I gave you. So that's all what I have for you. If you have any other questions, or if you have questions about other ratios that you'd like to get an answer to. Also, if you think maybe you've never looked at your ratios before yourself and you need some help, I'm happy to set up time one-on-one with you and your your balance sheet and income statement, and we can do quick calculations and then see what conclusions we can come to and see where you may need to dig into further to help you understand your business. And you should be, if you're familiar with these ratios, what you should be very capable of doing at any time, say, yeah, my current ratio is so and so. My operating profit percent is 30% or whatever. My gross working capital is XYZ. It should be, these are things that you should be able to rattle off the top of your head without having to go to an accountant or to anybody else.
Okay, I have a couple questions. I mean, you definitely need some sort of history for most of these ratios. Is there things you can do early on in your business or things that you should worry about early on in your business with the ratios? Before you
Well,
have a lot of history?
yeah, well, if you don't have a lot of history and are just getting started out on a regular basis, you should make sure you get your balance sheet and your profit and loss statement. And if you get those every quarter, you will start to have a picture. You will see what the thing looks like. So, yeah, without those statements, you won't be able to calculate any of this stuff.
What is the significance of the working capital turnover?
The working capital turnover is that I'm not sure I understand that. You kind of combine two words from two different areas. One is working capital and the other is turnover. Um, could you explain yourself a little bit more?
We'll come back to that one. We'll wait for some more information. If your debt to net worth is high, but it is because you are trying to expand, would that be expected? And is it okay short term?
Yes, it is. As long as the people from whom you are either if you've got bonds issued or you're borrowing from a bank, when they look at it, they should feel comfortable that this is only a temporary issue. So it's perfectly fine, but just you should keep your eye on that. You shouldn't let it, if it goes down to like I mean, not goes down, but goes up to like 2 or 3, then you just have to keep your eyes open. then you should start looking at your liquidity ratios and your cash flow to make sure there are no issues that you're having, because in your debt portion, you have to pay, you've got current debt obligations that you have to make payments for, and then of course the long-term debt.
So this question I may botch, but Lori, let me know, because I see she has two different parts, and so I'm assuming these go together. The first part was she has debt to net worth, and then she asks, if you don't have any shareholders, how do you look at that debt to net worth?
So on your balance sheet, I know I'm using the term shareholders, but essentially, let's say it's a small business and the only shareholder is the owner. So you just look at whatever is on your balance sheet under retained earnings. So all balance sheet have debt, which is part of your liabilities, and then you have the retained earnings, which is the net worth or the net value of your business. You don't need a shareholder to look at what the number is.
In the nonprofit sector, donors want to know what percent of income is spent on operating expenses. How do you?
That's a very good question, and all these ratios that I'm talking about really apply to for-profit businesses, but for a nonprofit business, you also have to file, even though you don't pay taxes, you file what is called a 990. And the 990, you break out what portion of your total expenses are on operations. You have to segment all your expenses. There's the operational expense, there's the administrative expense, and then also how much of it is on fundraising and for all unearned income activity. And so when the 990 is filed, your tax accountant will file that with one page that it looks almost like an analysis of a P&L, and it'll break it up into those three categories. And generally, you should make sure that your operating expenses or that category of expenses is at least 80 to 85%, and that your fundraising could be anywhere from 5 to 10%, and your administrative should be 5% or less. That's a whole different area. It's an interesting, Teresa, this is an interesting question we may want to think about for the future, to look at what are the main parameters and metrics that a nonprofit should be considering and looking at.
Oh, okay, great. Okay, next question. I calculate my cost of goods as follows. I take my beginning inventory plus the purchases for the year minus the ending inventory. Does that make sense?
Well, that is a calculation that you can do. That's a good substitute for calculating your cost of goods sold. But if you have a P&L, why are you not using the numbers from your P&L? Sorry, I'm asking a question back to the question.
Yeah. And then there's a couple of anonymous questions that may or may not go together. I'm not really sure. It really does help if you can keep your name on the questions, because then I know which ones go together. So I don't know what this one is. So working capital turnover is a ratio that measures how efficiently a company is using its working capital. It shows a relationship between the funds used to finance a company's ops and the revenue a company generates to turn a profit. I guess that's all. There wasn't a question in there. So is there a resource where you can find the consolidated reports for specific industries that you like to use?
Since I help people at SCORE in many different industries, I just do that on an ad hoc basis. I do use some tools in a textbook because I teach finance in a business school, and it's I do look it up over there. On top of my head, I can't let me just see if I can find some place, but maybe I can, Teresa, I can send some links or something when do people get these slides at after the webinar?
Well, they can access the recording. I don't usually, I don't always
Okay.
send the slides, but if you
Okay.
have information you want to send out, we can do that.
Yeah, I might let me after the webinar, I will look up some links of public sources where people can get ratios information, the primary ratio information even for the industries. And I can send that to you, and then maybe that can go out for anybody who wants it.
Okay. Love this question. I have never looked at ratios. How do I go about getting help? Call SCORE. That's the answer.
Yeah. Well, the first step I would say is I would suggest that you I don't know whether you keep your own, you probably don't keep your own books if you've never looked at ratios, but tell your tax accountant to print out or to email you the profit and loss statement and balance sheet, and then set up some time with me, and we can walk through that. And, we do our meetings are all on Zoom, so you can, share your screen, or if you don't think it's that proprietary or information, you could email that to me. Anything you do with the SCORE counselor is all confidential. And then I could help you work through that. And then you can just, all you need to know is how to subtract and add and divide. You just have to make sure you know which numbers you're using. That's all.
Is that a question? I think, oh wait, let's see, we just got another one. Okay, it doesn't have a question attached to it yet. Let's see. Okay, this person says she uses QuickBooks. You can get those reports out of QuickBooks as well.
Oh
For
yeah, yeah. If you
sure.
use QuickBooks, it's very, very easy. Just go into the QuickBooks section under standard reports, and that's it. You just click the button, enter the period of time, and you'll be able to get those right away.
And Pamela is asking about the ratios for a nonprofit. Conveniently enough, Ramesh is one of our nonprofit mentor experts. So, and I'm sure other chapters have similar folks as well. And so he could talk to you about those. And then you heard him mention earlier, maybe we'll look at getting a webinar set up for just nonprofit. But so that is something you can reach out to us, and we can set you up with somebody to talk about that. So that.
So Teresa, the
Yeah.
person who mentioned that working capital turnover, I understand what he or she was saying. It's basically another way of looking at what I just call looking at gross working capital, but you could look at your gross working capital amount at any point in time at the end of a quarter, end of a year, and then look at how that is changing. That'll give you the same kind of information, but basically buried in your working capital is your inventory turnover ratio, as well as what are your accounts receivable, days sales outstanding, and your accounts payable turnover. So the turnover driving working capital turnover is inventory turnover, accounts receivable, as well as accounts payable. So you could look at those if you wanted to dig a little deeper.
And we just got a comment about nonprofit webinars. I actually have 2 nonprofit webinars coming up. So if you go to the score.org/Boston website and look under that local workshops on that blue bar, and there's upcoming webinars as an option. There are 2 nonprofit webinars coming up. One is the basics of nonprofits, and then the second one includes information on how to prepare for a grant or grant writing. So definitely encourage you to take a look there for that information. And I put in the direct link if you want to try and copy and paste that out. But yeah, we do have 2 nonprofit presentations coming up. So, all right. I think that covers it, Ramesh. I think you did a,
Okay,
yeah, so we'll get the recording to, the recording will get posted by tomorrow. Ramesh is gonna look up those resources and we'll get information out to you, including some of the, some of the layouts of some of those slides. It won't be all the slides, but it'll be the important bits that folks are asking about. So I think that covers it. Thanks
okay.
everyone for joining us. Oh, go ahead. Did you have something?
No, no, I just say thank you.
Oh, okay, great. Thank you so much. All right, thanks everybody.
Bye.
Bye.